Uh, and thank you, everyone, for joining us this evening. My name is Rhonda Maco. I'm an attorney. I've been practicing for over 20 years, and a large part of my practice is about estate planning and generational wealth, legacy building, and making sure that you protect those assets that you worked so hard on obtaining. We're here with the Du Bois Bunch Center, and we are having these type of webinars because we understand some of the issues in the community that need to be brought to the forefront. So I'm happy to speak to you tonight about using insurance as a planning tool, which is something that is very important. And it's so good that so many of you have joined us tonight. We also have Yanette Goodridge, who is an agent from New York Life Insurance, and she will also be able to speak to you about some things related to insurance and tell you about some different products that are available. This webinar is very important because we want to just make people aware about insurance and all of the different ways it can be utilized in your estate planning. We have to really understand that it's just not something you use when you think about, burial insurance, which is something that is very big in our communities. But that's not the only type of insurance out there. So I'm very excited to talk about insurance planning tonight, and I hope you'll be able to take some great notes. So let's get started. I'm going to share my screen, and I hope you are able to see it. Please let me know. Can everyone see that okay?
Yes, very good.
Yes.
Okay, great. So, all right. So now, once again, welcome everyone. We're going to discuss how life insurance serves as a critical planning tool for protecting your family and preserving wealth. That's very important. Life insurance isn't just about a death benefit, and we have to really understand that. And if we can get that point correct, then we can start opening up our minds to all the different possibilities that insurance can bring. It's a versatile financial instrument that supports estate planning, asset protection, wealth transfer, and long-term family security. So let's explore how the right coverage, insurance coverage can make a meaningful difference for you and your loved ones. So when we talk about insurance planning, again, we're talking about protecting your family's future. So just understand that life insurance is one of the most powerful tools for safeguarding your loved one's financial security. Whether you're planning for estate transfers, income replacement, or legacy preservation, the right policy ensures your family is protected no matter what. So just keep that in mind. A lot of people don't even think about insurance in terms of income replacement. When you think about what's going on today, if some of us had insurance policies in place, then we would be prepared for, some of what we're going through, some of what we're going through now, where we're seeing, gas prices coming up and people are, jobs are at risk, and there's a lot going on today. And insurance can be an effective tool to help you deal with that. So we're talking about estate planning, asset protection, wealth transfer, and family security. So now, what do we really mean when we say life insurance planning? Again, it's much more than purchasing a policy. It's a strategic process that integrates insurance into your broader financial and legal framework. So that's something, again, that a lot of times we don't think about. We got to think more broadly when we think of insurance. The goal is to ensure that your coverage aligns with your estate plan, your tax strategy, and family protection needs. So I'm going to talk about, I'm going to give you some bulletins so that way you can really understand what we're talking about when we say insurance planning. So one of the things it does is creates a financial safety net for your dependents. Insurance can do that. It can also provide liquidity when your family needs it most. It can support long-term estate and tax planning strategies, helps replace lost income and cover final expenses, and you can coordinate it with your trusts, wills, and beneficiary plans. Yanette, I want you to jump in here, but I was just speaking to someone the other day. We were talking about, some of you have insurance policies where you have a beneficiary, which is fine, right? You should have your beneficiary on there. But some of your beneficiaries, let's just say that they're not even minors, but let's just say they're 22 years old. Unless you've educated this 22-year-old about how to utilize money, and let's just say that that insurance policy we're talking about is $1 million, right? That 22-year-old would get $1 million outright, but that's not effective generational wealth if that person does not have the education to know how to keep that money. Do you understand what I'm saying? You could,
Absolutely.
but what you can do is put that money into a trust and have it a spendthrift trust, right? Where they get certain amount
Mhm.
at certain intervals, even monthly, if you're talking about $1 million policy, and have that person understand, have a trustee in place who can help them understand the importance of how to use that income now that they're getting monthly, or I don't know, quarterly, whatever way you do it. But you got to have it. Generational wealth is not something that happens automatically. It's a combination of funding as well as education in order to make sure that the money continues to transfer down to the next generation. So, do you want to add something to that, Yanet?
Uh, I definitely agree with you 100% because that's something that we talk about in my at New York Life. If you have a sizable policy and the beneficiary is a young person, it would be advantageous to put that policy in the confines of a trust, and hence the term trust fund baby. So we can have that too. It's not just for a specific community of people. We can also have that where the person will be financially secured for years to come,
Mm-hmm.
with the benefits from the life insurance proceeds. And of note, the life insurance proceeds is tax free.
Yeah.
So whatever that benefit is, that's what your beneficiary will get
Mm-hmm.
without any tax obligation. And the I like the bullet points where it says, creates the financial safety net for your dependents. And actually, yes, because most of us love our families. And for those of us who are married or have a partner, or you may be single, but you still have a family,
Mm-hmm.
God forbid something should happen to you. You do need protection, whereas if your children are still minors or they're in college, how will they survive should that income be taken away suddenly from them? And so that's where life insurance comes in, and that there's a different types of life insurance that is cost effective for certain protections.
Mm-hmm.
So, for instance, term life insurance is used for income replacement and mortgage protection. Because also that is of concern because sometimes the one of the breadwinners would pass away and the remaining person is unable to carry that mortgage. So having covering the mortgage balance with a term policy prevents the remaining spouse or partner or the children from losing the home. They're able
Mm-hmm.
to pay off the mortgage or however they choose to, invest the money so they can pay the monthly mortgage continuously. It's up to them. But yeah, so protection is of utmost importance. And as Rhonda, you rightfully say, it's not just final expenses, and it's
Right.
for, leaving a legacy. If
Absolutely. And
yes.
Janet, I'm going to ask you to talk about some of those types of insurance a little bit more in depth, um,
Mm-hmm.
so that the way people understand exactly what we're talking about.
Mm-hmm.
So why life insurance matters. That's very important for people to understand. And this slide highlights why it actually matters. Income replacement is often the most immediate concern. You know, what happens to your monthly bills or the mortgage payments, like Janet said, and daily expenses. Debt protection prevents creditors from burdening surviving family members. Education funding ensures children's futures aren't derailed. And then estate equalization is especially important when assets include a family business or real property that can't be easily split. You know, a lot of people don't think about that, but we'll get more into that. Business continuity ties into a later slide that when we talk about succession planning. But just understand that without proper life insurance, your family could face serious financial hardships during an already difficult time. Life insurance provides the foundation for a secure future. So, again, we just talked about income replacement. That ensures that dependents maintain their standard of living after the loss of a provider. So as Janet had mentioned, so we could be talking about someone losing a job or someone losing their life, right? And a lot of times we have lost income for different reasons, and an insurance policy can help with that. So, Janet, what type of policy will we be talking
That
about if
would
we're
be
talking
an
about income?
individual disability insurance policy.
Hmm.
So that is specific for income replacement should you have a disability, whether it's, you know, temporary or on a long-term basis. So
Okay.
yes, and that's important. A lot of employers offer long-term disability, but it doesn't pay 100% of your salary should you have an event. And I always encourage clients to find out from the benefits office how much the is covered, their salary is covered, and usually it's between 50 and 60% of the salary
Hmm.
that you earn. That's what the benefit is through the employer. However, you do have to pay taxes on the money, and they will take out Social Security benefits from that 60%, your health insurance payment on whatever deductibles you have
Hmm.
prior to your long-term disability. So the question is, can you pay your bills comfortably with the 60% less all of those deductibles and the taxes? So that's where a standalone individual disability insurance plan comes into play to bridge the gap.
Right. And
So
I'm
you
glad
can
you
be made whole.
and I'm glad you brought that up because I've had these conversations with individuals who say, "Well, I have long-term insurance through my employer."
Mhm.
And what they don't understand is that when you factor in the deductibles, um,
And the
that
taxes.
the taxes and all these different things that have to come out of that, policy is not going to um, sustain you or put you in the same position you were prior to your disability or whatever stopping you from working.
Yes.
And so that's why we have to have these conversations. And a lot of times people think that they have the right amount of insurance, and it turns out that they're underinsured. This is not about trying to get you a policy that you don't need. It's about trying to get you to understand the true purposes of insurance and how you can make it work for you. And we have to think again, it's a proactive move where you have to think, okay, what is my overall broad, accomplishment? What am I trying to accomplish here? And also think about what profession you're in. A lot of times people don't factor that in. I'll give you an example. I mean, you know, I'm an attorney. My husband's job is more physical. He's in the fitness industry. And the reality is while we both can get hurt, his his ability to get injured is a lot higher than mine. And if he gets injured, for example, like, you know, if he broke a toe or something like that, he would be out of work. Whereas if I broke a toe, I could still
Mm.
work. This is the level of conversation that you have to have. Like you have to be conscious of, not only if you get hurt, but what type of injury and what would stop you from working. I can work from literally anywhere, right? I could work from home, I could work from another country. I could do a
Mm-hmm.
lot of different things if something stopped me from, walking for, temporarily. So that's why it's important to make this assessment to understand why you need to get insurance that goes beyond what is provided by your employer. And a lot of times people don't even know exactly what it means when they signed up for something with their employer. Were you going to say something, Yanette?
No, that is absolutely true, because prior to me coming to New York Life, I always take whatever the employer offers, I don't leave anything on the table. But did I have a true knowledge of what it was that I signed up for? No. But coming to New York Life provided me with the questions as to why I did what I did back then. So
Hmm.
I have a responsibility to share with others, because if you're not in the industry, most times people will not know. You wouldn't know what to ask, what questions to ask, and
Right.
that's important. So I'm always on my proverbial soapbox sharing information, because
Absolutely.
we need to know why we have what we have. And sometimes some people may have policies that doesn't make sense for them,
Hmm.
you know. And some people have an accidental death and dismemberment policy, and they think it's a straight life insurance policy because no one really explained to them that it's you have to die by an accident or be dismembered in order for that to pay out.
Hmm.
So, so it's
Exactly.
important.
Absolutely. So that's just income replacement. Debt protection is another issue. It covers mortgages, and Yanette had mentioned that loans and credit obligations so your family isn't burdened. We also, what about education funding? Guarantees children's college and education goals can still be met because again, life happens. But if you have some things in place, you can be sure that your kids can go to college. Um,
Yes.
that's actually what we did. I had gotten a policy, and this is a very touchy subject, maybe on that you can shed some light on this, but
Mm-hmm.
my husband and I did get insurance policies on the kids. And I remember having a conversation at a webinar before where I said that, and I could hear the gasps in the audience. People were like, "You got insurance policies on your kids? That is just unbelievable!" And they couldn't understand. And I was trying to explain that I'm looking at this in a completely different way. So if you can shed some light on it, it's not, I- I'm not looking at this in any type of morbid type of way. This is
No.
what I'm looking at to fund my kids' college. And we were actually able to do that.
Right. So if you um so let me preface this by saying once a baby is born and they're assigned a social security number, you can take out a cash value whole life policy on them. And it will be the cheapest ever. And so that means you can take out a large face amount policy and customize it, meaning you can decide, I want this policy to be paid up, fully paid up in 20 years. So you're paying accelerated payments per month. And what that does is the premium builds cash value that you can use. It's not a death benefit, it's a living benefit. And so
Mhm.
this is why some people in other communities, they understand that and they would take out some of them who can afford it, they will have $1 million policy on their kid, because when the kid is an adult, the cash value on that policy can purchase a home, or it offsets the college expenses, or buy a car or whatever, and it's the gift that keeps on giving. because you can never deplete the cash value in a cash value whole life policy, because as long as you're paying premiums and even after the customization period ends, it still earns cash value. So down the line, they can tap into it. A wedding is coming up and you need 10,000, 20,000. As long as you have the cash value in the policy, you can use it without any questions asked. So it's considered a buffer asset.
Mhm.
So instead of thinking that, oh, you're putting a policy in case your kid dies, no,
Right,
it's for living benefits
right.
where if you have a cash value whole life policy and you have cash value in there, you can use it without any questions asked. There is an interest rate assigned to it, just as if you have equity in a home and you want to use it, you have to pay an interest rate. But the difference is you don't have to pay back that loan if you don't want to, and
Hmm.
no one harasses you to pay it back, and they don't run your credit record. Nothing like that. As long as you have it, you can use it.
Right.
Yeah.
But and I remember because I had taken out a loan from a policy that I had, and I remember you, you don't have to pay the loan back. I paid the loan back, but if you didn't pay the loan back, as long as you pay, I would say pay the interest so that way
Yes.
it doesn't eat up the dividends that come on the policy. Can you talk about that a little bit?
Yes. So once a year on the policy anniversary, you get a bill for the interest on the loan. And some people pay it, some people don't. But what that does is if you don't pay the interest, it rolls into the principal. And so that makes the loan bigger. And over time, it keeps growing. And that's eating up money that you need to use from the policy, your cash value. So what I encourage clients to do is to pay when you get that interest bill, just pay it, you know. Or some people would prefer to pay down on the loan. It's up to you because you're paying yourself back. Because
Right,
when you pay that, it goes back into the policy. So it's more for you.
right,
And and also, when if you're an adult and you take out a cash value whole life policy, and you may not need the equity, but when you retire, and let's say your boiler breaks or whatever, and it's like, oh man, I don't have this ready cash, and you have equity, you could use that. So some people use it to supplement their retirement in their retirement years too, you know. So at will. And the point is the living benefits for a cash value whole life policy is necessary because it's difficult for most people to have what 3 months or 6 months worth of salary and all of that. But if you have a nice whole life policy with cash value, there's your emergency fund right there.
mhm,
So
absolutely.
you're allowing the premium you're paying to work for you because it's growing equity every single time that you make a payment.
Right. And
So
so instead of looking at this as, oh my gosh, you took out a policy on your child, that's a morbid thing to do, or it's a death benefit. No, it's a living benefit. And I think that's the best way to put it because you're thinking about the future and all these different things that you want to do for your child. Like you said, education, wedding,
mhm.
whatever it
Or
is,
whatever
car,
it is,
all those
a down
different things
payment
that
on
you
a
do.
home.
Right.
Yeah.
So just again, it involves a mind shift in terms of how we view insurance and what we can actually do with it. So when we understand the different benefits and opportunities um, with that insurance policy, then we can move forward and see um, a lot of things that we did not see before. So just
Mhm.
just think about that. Um,
And can
now,
I mention something
sure.
that also if you're unsure of, the discussion we're having in terms of the cash value whole life policy, I encourage you to read the book, What Would the Rockefellers Do? Because that's exactly how they amassed their fortune. They took out cash value whole life policies on all their kids and they use the proceeds from the cash value to fund business ventures. So that will give you an idea of,
Well,
and people have been doing it for years. We just didn't know about it, and it's very recent that a lot of us learn about what the possibilities are in terms of those types of policies. So you can look into that.
it's called What Would the
What would the
Rockefellers Do?
Rockefellers do? Yeah.
That's the book. I just put it in the chat so you have that. Um, so that's a good book for you to read. And then also Estate Equalization. It provides fair inheritance among heirs when assets aren't easily divisible. I just want to talk about that real quick. So I talk about this all the time when people ask me about, you have that one family house and you want to split it equally between your children, but sometimes that's not the best thing once you understand your children and how they view certain things. And sometimes it's not the best idea to split it or put everybody on the deed. I have these conversations all the time. Sometimes it might be best to give the house to one person and then supplement by getting an insurance policy that will be comparable to another um, uh, child or whoever it is that you're trying to give an asset to, because this is also a way for you to avoid conflicts. Oftentimes, when someone passes away because they didn't do the proper planning, not only do you have conflict, but now the money that you have amassed is going in a different direction than you expected. And other people are now getting a cut of that money. Now we're talking about legal fees, we're talking about court fees, we're talking about, God forbid, you have to get a public administrator involved or all these different things. So you have to really think this through. And I'll give you an example. Like sometimes you listen, everybody has different family structures. You have stepchildren, you have biological children, you have all types of different types of families. And not that you need to treat people, you know, sometimes you do have to, give people, what you feel is best for them. That's your decision. It's not about treating someone better or anything like that, but it's about your determination of what you want to do with your assets. So to that extent, sometimes it requires you to give someone more than another person. Even I see people do that all the time. You have one child sometimes who has done a lot more or contributed to certain things, and then some people want to give that child more. So, there's a lot of different reasons why people want to do what they want to do, but you need to think it through. And if that's the case, um, then you need to make certain provisions. Also, when it comes to siblings, sometimes, again, you know your children better than anybody else. And you have to be honest about, who they are, their personalities, their characters, and how things would work out if you gave a house that was supposed to be split between three people, but yet you want that house to continue to be in the family name. Again, as long as you know who you're dealing with and you've thought this through, you can make whatever provisions you want, but just be mindful that sometimes you have to go outside of, the box and think about this and really structure something that will work. And insurance is a great buffer to do that. So that's why when we talk about estate equalization, think about your specific family dynamic and how it works. I mean, some people, yeah, again, we all have type blended families and different dynamics that we need to take into consideration. So just keep that in mind. Um, do you want to say something on that?
No,
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 okay.
that's
Okay. And then business continuity. I've spoken about this before. We had a webinar that was specifically on succession planning. A lot of times, again, we have businesses that You know, sometimes we do not incorporate it properly. And then God, God forbid something happens where someone passes away, and then now the next of kin inherits this business and they don't have any money to do the things that need to be done in order to make sure the business is now operating properly. An insurance policy can help with that. You
Yeah.
have an
The back.
insurance policy put in place where,
Mhm.
when someone passes away, now they have money to expand or fund certain operations or do other things that can make sure the business will continue. Go ahead, Yanette.
And also, if you're in business with someone else, you have a business partner, this is where the buy-sell agreement comes in, and there's a
Hmm.
where you take out a life insurance policy on each other. So what that does is if should one of you pass away, then the policy will pay the equivalent of their share of the business to the beneficiary, the family. So you are not in contention with your partner, their deceased partner, business partner's
Hmm.
family. And so you can continue on the business solo or get another business partner, and they were paid off by way of a life insurance policy.
Yeah, that was one of the examples I was going to talk about, but I'm glad you
Yes.
brought it up now, because again, a lot of us are entrepreneurs and we have these businesses that we started and we want those businesses to live, beyond us. So in order to do that, we have to really take into consideration all these different things and make sure that business not just survives, but thrives. And we can do that by having an insurance policy that will cover that. So that's a great point. So now
Mm-hmm.
the types of insurance in your plan, life insurance that provides death benefits, life benefits, and can build cash value over time for your beneficiaries. Disability insurance, which replaces income if you become unable to work due to illness or injury. Long-term care insurance, we had a webinar on that, but that we always need to talk about long-term care insurance because I feel as if people are always um, just bypassing that type of insurance, which until it's too late. That covers nursing home, assisted living, and home care costs. And then we have health, business, and annuity products, which protects against medical expenses, safeguards business operations, and provides guaranteed retirement income. But let me just go back to the life insurance part. So, Yanette, I know when we
Mm-hmm.
say life insurance, we're talking about whole life, which we touched on, but I want to make sure that everyone understands that whole life, term life, and universal life. Can you give the differences between those three types of insurance?
Yes. So term life is temporary. So you can have, well, I'll speak with what New York Life offers. New York Life offers a 10-year term, 15-year term, or a 20-year term. So that simply means you will pay the same premium for whatever duration you've selected, 10, 15, or 20 years. It's the cheapest insurance because you get a lot of coverage for a small amount of money because it's temporary. It's a straight death benefit policy, and it's it's used mostly for income replacement or mortgage protection, and oftentimes some people may desire to have a whole life policy, but they can't, that it does their budget doesn't permit at the time that they'd like it. So you can start, it's a great way to start your life insurance journey with a term life policy, and you can upgrade that policy to a whole life policy. Of course, you'll pay the whole life money, but you lock in your insurability. And if for those of us on here who are interested, you can always, reach out to me and I'll go more in depth with what, it entails. And then there's the whole life cash value permanent policy where the premium remains the same for the life of the policy, except in the case where you customize it to be fully paid up, let's say 20 years or 30 years, which is the maximum. The least amount of years you can accelerate the customization is 5 years. So between 5 and 30 years, you can customize the policy. And most of my clients who are younger, they take advantage of the customization because it's great. If you can have a fully paid up policy in 20 years, no more premiums due after then. It's wonderful. You don't have to worry about should my finances get a little shaky, losing your policy. You wouldn't have to worry about that at all because it's fully paid up and you're set. And then there's universal life, which is a hybrid between term and whole life. It's uh it's affordable when the younger you are, but it rides on the cost of insurance based on our age. So as we get older, the premiums has to be increased, otherwise the policy can lapse and you no longer have insurance. So it has to be monitored appropriately and overfunded so that it can last for a lifetime. So, some people go for that. I'm not such a big fan of universal life, but it's a the option is available. And you can also customize the universal life policy,
Mhm.
which will avoid all of those any opportunity of it being lapsed, in the future because you're not funding it correctly. So yes, those are the three main options in terms of life insurance.
And thank you for that. And
Mhm.
I agree with you,
Mhm.
especially about the universal life policies. If you decide, I hope you're taking notes. If you decide that you're going to get a universal life policy, just please make sure you're understanding what you're getting into. I hate to say this, and I could be wrong, Yanette, but I equate the universal life policies to when people get mortgages where they have these balloon payments because they didn't
Yes.
realize that they have it, and that's why I
Mm-hmm.
don't like them, because when people finally realize what they got into, it's too late.
It's too
And then
late.
then then they realize that the premiums continue to go up and now it's not affordable, as opposed to you getting a term policy or a whole life policy where you don't have to worry about, the older you get, the larger the premiums will be.
Mm-hmm.
So a lot of times people just
Yes.
don't understand that. And I think that
Mm-hmm.
before they get involved in that type of policy, they need to really understand
I
how it
agree.
works. Hmm.
And for those on this Zoom meeting, if you already have life insurance and you're not sure and you need to have a working knowledge of what you have, I'm also available to do a courtesy review. So because I feel strongly that everyone should know what they have and how it's serving them, and the sooner you know, the better, because as you know, once as we get older, the cost of insurance goes up, and if you have certain health concerns, you can become uninsurable. So the
Hmm.
time to put protections in place is always yesterday.
Right. Absolutely.
Mm-hmm.
And I do encourage anyone who has insurance policies that they've had for a long time, because I've seen this happen before, where you have an insurance policy, you've been paying on it for 20 years, and you're not really sure what the face value is. You're not sure, what the benefit is going to be. Get someone to look at that, review that policy so you understand what you've been paying for all these years and whether or not this is still going to work for you.
Yes,
Thank you for that.
you're
So,
welcome.
so the next slide is to talk about how life insurance is for estate planning. Estate planning is one of the most important applications of life insurance. Um, when someone passes away, the estate often faces immediate expenses. We're talking about taxes, legal fees, debts, and administrative costs. But without liquidity, heirs may be forced to sell property or investments at unfavorable prices. Because see, you're under pressure now to get something done. And, that's the worst time for you to sell or get rid of something because people will try to take advantage of you. So life insurance solved this by providing immediate cash. Um, Insurance can, like we discussed before, fund trusts, equalize inheritance when one child inherits a business and another doesn't, and how it enables also multi-generational wealth transfer. So just keep these things in mind. Life insurance is a cornerstone of effective estate planning. That's what you need to know. It creates immediate liquidity at the moment your family needs it most without waiting for probate or asset liquidation. It pays estate taxes and settlement costs so heirs don't have to sell assets. It can provide immediate cash for surviving family members, fund trusts and structured inheritance plans, which I always encourage, equalizes inheritance among children and heirs, enables wealth transfer strategies that preserve assets across generations. So these are just some of the reasons why life insurance should be used as an effective estate planning tool. So we talked about this, Yonette talked about this term versus permanent life insurance. To the extent that need to have more explanation about the differences between the two. Yonette has offered to, speak to you about that, but just you understand the difference is essential for choosing the right coverage for your needs, right? Um, Term life insurance provides coverage for a specific period. You said, Yonette, New York Life does not offer a 30-year term policy.
No.
No. Okay, so there are some companies that do offer that, but 10, 20, or 30 years, most affordable option with no cash value, right? So it's ideal
No.
for temporary needs like mortgage protection. The bottom line is term insurance is going to be is going to be cheaper than whole life insurance because again, term insurance does not build up that cash value. And it's for a certain time period.
Mm-hmm.
Whole life
Yes.
insurance, on the other hand, is lifetime coverage with guaranteed cash value growth. Premiums remain level, and it provides both protection and a savings component.
Right.
So people always talking about that savings account that they have, but your insurance policy, your whole life insurance policy has a savings component to it as well. That's why you're supposed to
Yes.
diversify, right?
Yes.
And I think we need to look at that some more. But the first thing someone will tell me is, I can't afford a whole life insurance policy. And I think we need to rethink that once we understand the benefits of those type of policies.
And may I add that New York Life is a mutual company, so which means that they share their profits with um, policyholders who have, whole life policies. So in addition to the cash value that is being billed through your premium payment strength, you also have the benefit of earning dividends. Well, it's not guaranteed, but New York Life has never missed a year in paying dividends
Mm,
since they started,
yeah, that's
so
that's good to know.
right. And so the dividends or a lot of my clients they opt to pour the dividends back into the policy, which increases the debt benefit as well as your cash value growth, and so it's beneficial. However, they separate. So if you have a whole life policy through New York Life and you have your online portal, you'll see your cash values is available for loan. It's separate, and your dividend pool is separate. So you have the option if should you need some money, you can either take a cash value loan, or if you have your dividends and it's enough, you can take the dividends and you don't have to pay it back. It's not a loan, there's no interest rate, there's no taxes. So so all of these things, the benefits. So that is why the whole life policy costs more. but
Hmm.
you can't beat the lifetime,
The
the
benefits.
benefits, the
Yeah.
living benefits. Yeah.
Absolutely. And then
Hmm.
we also talked about the universal life insurance again, flexible premiums and adjustable death benefits. Cash value earns interest based on market conditions. So you have to be very careful when you get that type of policy. Some people sell it as a viable option, but you have to be very familiar and understand what is being presented to you before you get that type of policy.
Right. And most of us don't read our mail when we get it from the insurance company. Um, I don't either, but because I have access to my
Mhm.
stuff, I know what's happening. But there are quite a number of people who have a universal life policy and they've never increased the premium, and no one does a review with them. So, and those are the people when they're in their 70s and 80s, it will be very disappointed because
Mm,
right, they're not paying at the level of the cost of insurance.
hmm.
It's always important to, have a review, ask for you know, uh a updated schedule of what's happening with your policy. And like I said, I'm here for courtesy review if I don't mind doing that at all because it's important. And I get excited when people already have life insurance. So because my platform is to inform
Hmm.
my community, whatever, however they look, whatever they look like, it's not about a race thing, but especially black and brown people, we're behind the eight ball with
Hmm.
our protection, putting protections in place and planning and stuff that will help our families. Because when you have protection in place, then your children will not be starting over from scratch.
Right.
And we have to break out of that habit of everybody have to fend for themselves. Yes, they
Absolutely.
do, but you should also be legacy minded because
Hmm.
and that will improve our quality of living going forward and stop the generational habits of lack.
Right. Absolutely. I totally agree with that. And so, with that, let's just make sure you understand the cash value life insurance, right? So it's permanent life insurance policies, built cash value over time, creating a
Mhm.
living benefit, just like Janet said, living benefit you can access during your lifetime. Tax deferred growth of cash value over the life of the policy. You can borrow against your policy's cash value for emergencies or opportunities. Again, you can pay it back or you don't have to pay it back.
Mhm.
Nothing's going to go on your credit report. It'll reduce the death benefit, right? But
Yes, if you pass away and there's a an outstanding loan, it will be subtracted from the death benefit, and your beneficiary will get the balance.
right.
Mhm.
But you don't have to pay it back if you don't want to, but you can. But again, like we said, if your policy has dividends, you want to at least pay the interest on that loan, so that way the interest doesn't eat away at the dividends that the policy pays, right? So again, it's a strategy. You got to understand what you're doing before you do it, so that way you come out ahead. Supplement retirement income with policy loans or withdrawals. You can use the
Mhm.
cash value for premium payments during financial hardship. And you can have,
Yes,
it's advanced planning strategies like premium financing and split dollar arrangements. So again, it's a
right.
strategy. It's all
Yes,
about strategy. This is not
yes,
about, oh, this is what somebody's going to get when I pass away. And I think that's the fundamental issue that we're trying to address here tonight, that people look at insurance as something that's payable upon death. So you're
yes.
not even looking at it. It's your policy that you own. You have a beneficiary or beneficiaries. And of course, you are thinking about them. But strategically, you can be using this policy during your lifetime. And that's what we really need for you to understand. So that way you can take advantage of all the different opportunities these policies have. Life
Yes.
Go ahead. Do you want to add something, Janet?
No, it's the previous slide, what it said that,
Yeah,
can
I'll go
you
back.
switch it?
Sure.
The advanced planning strategies, because it's coincidentally, I spoke with someone I know who's a client of New York Life, but not my client, but she's a friend, and she has all her protection in place, and so she's using the dividends from her whole life policy to pay the dividend on her long-term care policy,
Hmm.
because she's had them for a while, so she's using the dividend pool to pay her premium.
Hmm.
So it's a lot of strategy. So, with clients who, you know, they will call me up, and I would, tell them what the best option would would be. If you have multiple policies and some of the interest rate is lower than others, you can,
Hmm.
there are things that you can do to take some money from one and pay down the loan on the other, and different,
Right.
it's strategies,
Yeah,
and it's
it's
all,
options.
it's
Yeah.
options, and you know yeah.
Yeah, very good.
Mm-hmm.
So, life insurance and trust planning. So, combining life insurance with trust planning maximizes protection and control over how benefits are distributed.
Mm-hmm.
So, you have irrevocable life insurance trusts. A lot of times when people talk, come to my office and they want to talk about trusts, people already have in their mind what trust they're talking about, but people don't understand that there are tons of trusts, different type of trusts, and people need to be educated on the different type of trusts that are out there, so that way they can get the type of trust that's going to work for them. So, an irrevocable life insurance trust owns your life insurance policy, and it's keeping the death benefit outside of your taxable estate. This can significantly reduce estate tax liability. So, when you talk about irrevocable trusts, generally speaking, when you put an asset in an irrevocable trust, it is no longer a part of your overall estate. That asset now is no longer part of your estate. So your total amount of assets in your estate has now been reduced. But it has to be an irrevocable trust, meaning that you can't take it back. It's in the hands now of the trustee, and it's in this particular type of trusts. So usually this comes up when, couples or single person is going to hit that millionaire tax, right? But there are, you can, like I said before, you can put insurance policies um, in a trust as well. But, you'd have to sit down with an attorney and speak about
Mm-hmm.
that, and sit down with your insurance person to go over it and understand exactly what you can do. And this type of trust provides asset protection from creditors, controls timing and conditions of distributions, shields proceeds from estate taxation, and ensures benefits reach intended beneficiaries. So, again, I know that people like to have beneficiaries. I always tell clients to make sure they have beneficiaries on everything. But then when you think it through in terms of how you want the beneficiary to have it, they can have immediate access to cash, but then you can structure it in a way that will be more beneficial to them, especially when you're talking about trying to create generational wealth and being legacy minded, as Janet said. You really want to think it through more so that way you can maximize these benefits over time. It's very important.
Yes.
So we also talk about business succession planning. Again, if you go to our YouTube channel, to the Boys Bunch Center, I believe the succession planning video is up. We talked about that. But just understand that life insurance plays a critical role in ensuring smooth business transitions when an owner or partner passes away. Um, as Yanette, you already spoke about this, but it funds buy-sell agreements, so surviving partners can purchase the deceased share.
Mm-hmm. Mm-hmm.
Um, This happens more often than you think, where someone passes away and then now um, the surviving business owner or owners now has an unexpected business partner, right? And it could be someone who knows nothing about the business, who didn't necessarily want to be involved with the business, but now sees it as an asset and wants to get involved and say, well, how much money do I get? You can have insurance who can buy that person out with if you have a buy sell agreement in place. And this is why I also tell people that they need to have all their business documents in order. You need to have your operating agreements or your shareholder agreements in place and coordinate that with a buy sell agreement as well as your estate planning. So that way everything is in alignment with each other so that way you don't have any issues. So the insurance also provides immediate liquidity to keep the business operating during the transition, because that's important too. It protects the family's financial interest in the business. It supports family-owned business transitions across generations. I've seen so many times where you had a family business for decades, and then all of a sudden one person passes away and the whole operation falls apart. But if that's the case, then that just tells you that that one person was holding everything up. There are a lot of things that has to happen in order for a business to continue after someone passes away. Life insurance is just one aspect, but it's a very important aspect of it. So you have to realize that planning is very important. And then finally, insurance can cover cost of recruiting and training replacement leadership. Not even just the death of someone, but the replacement of someone who walked away from the business and got another job. If you need a manager, if you have a restaurant, for example, and you know, um, someone passes away, and then as soon as that person passes away, now the head chef leaves. That insurance policy that was put in place can cover the replacement for someone who needs to be in that leadership position. Because the other thing too is when you're trying to replace someone in the business, you have to pay people what's comparable to what they're being paid in that particular profession and in that position. You can't just offer someone, oh, I'll pay you minimum wage when you have other, restaurants paying people far more than that. So you want to be competitive as well so you can recruit and train the right people. So again, it requires you to think more long term and just think of broader issues that may come up that you will solve through having the right insurance coverage. This is very important. So, key person insurance. Key person insurance protects your business against the financial impact of losing a critical employee, the founder or executive. It covers lost revenue during the transition period after losing a key contributor, help stabilize business operations and maintain investor and lender confidence, right? Because a lot of times small businesses have cash flow problems, which is always a problem for small businesses, but you can, stabilize business operations through insurance. Funds recruitment, hiring, and training costs for a replacement and can satisfy loan covenants that require coverage on essential personnel. D&O insurance, I've talked about that before. That's directors and officers insurance, or E&O insurance, which is errors and omissions insurance. Um, and then frequently used by closely held businesses, family firms, and startups. So again, I tell people if you're in business, you definitely should have an insurance broker. You should have someone who can advise you. You should review your policies at least annually. And in some cases, you should do it even more frequently, depending upon where you are in your business startup. So you got to really be able to do the right things, but understand you have to have the right people on your team in order to make sure these things happen. Disability insurance planning. It replaces a portion of your income if illness or injury prevents you from working. We already talked about that. Like I said, it's often called the most overlooked form of protection because people think they're covered when they're not covered. Replaces up to 67% of your pre-disability income. It's essential for professionals, business owners, and anyone who depends on earned income. Short-term policies. Oh, someone said my screen is not sharing anymore. Oops.
No, it's good from
Oh, it
our end.
is? Oh.
Mm-hmm.
Is
Mm-hmm.
there anyone who can't see my screen? Let's see.
I can see it.
Oh, you can see. Okay.
Yes.
Okay, good. Okay. So, short-term policies cover weeks to months. Long-term policies extend to age 65 or beyond. It helps maintain your family's lifestyle and meet ongoing financial obligations. Business overhead expense policies keep your practice running during recovery. Again, Yanet is someone who would be able to speak to you about the different types of disability insurance that you would be able to get. So it's really important that you look into that. Long-term care insurance, we did a whole webinar on this. We talked about long-term care insurance and Medicaid. Long-term care insurance helps cover the substantial cost of nursing homes, assisted living, and in-home care that standard health insurance does not cover. So the thing is, and especially in Black and Brown communities, um, we always say, we would not want our parents to go into, or our grandparents to go into a nursing home. That might be the goal, but sometimes that's not a realistic goal, depending upon what the needs are. So again, when we make these determinations in our head of what we would like to do, we need to be realistic, especially, if you can't afford to take care of someone full time. We have to be realistic. 20, 30 years ago, that those were possibilities. But today it's not really feasible for a lot of families to do that. I'm going to stop sharing real quick so that way I can share again because I'm being told that people can't see my screen. So let me just try that again and go back. Okay, can you guys see that?
Yes.
Okay, good.
Yeah.
All right. Um, so just think about it like this, and I may be wrong on these numbers, so you tell me on that if this is increased. The average nursing home costs exceed 90,000 per year and continue to rise annually.
That's true, and it depends on location.
hmm
Mm-hmm.
is it, so just think about that. That's a lot. This is why, you have to get these trusts to protect the one asset that some people have, which is their home, because these fees can rise very quickly, and you want to protect these assets that you have. But long-term care insurance protects retirement savings and investments from being depleted by care costs. It support
Yes.
it supports Medicaid planning and elder law strategies by preserving assets. There are hybrid policies combine life insurance with long-term care benefits for greater flexibility, and planning early locks in lower premiums and better health qualifications. Yanette, can you talk about the hybrid policies of life insurance with long-term care benefits?
So that would be a whole life policy. There's
hmm
a rider called chronic care rider. It allows you to accelerate up to 90% of the face amount of the policy, and the minimum face amount, it has to be at least 100,000 face amount. So it allows you to accelerate up to 90% of the face amount towards your care. So at the time of the crafting of the application of the policy, you have to elect if you'd like 2% every month of this of your policy to go towards care, and it gives you the breakdown of what the daily amount would be. And it so should you have a long-term event, you can request that, and your life insurance money will pay for your care
Mm,
for 2 years or however, how much ever, how long, whatever you requested on the application, because you have to make that election at the time of crafting the policy. So it's important for me. Even if you have a long-term care policy, I would even say if you can add a chronic care rider on your whole life policy, should you get one. It helps to secure additional benefits if you need it.
mhm.
Um, and the money can go towards care in the home, because most times when people have a health issue, the care starts at home.
Mhm.
Or if you need to go to rehab, it helps to offset the cost. Um, or if you have to go to assisted living or a nursing home, it offsets the cost too. The big difference between the chronic care rider on your whole life policy and the standalone long-term care policy is that the long-term care policy comes with a care coordinator, and
Mm,
they pay whomever it is that you have to assist you directly. So all your concern would be is getting better, or being, taking care of you, being stable, whatever. They handle that, the claims department. So you don't have that benefit with the chronic care rider, but it's good to have.
okay. In the perfect world, would you prefer to get the standalone policy as opposed to the rider?
Well, actually, I tried for both,
Okay.
right? Because I know that the long-term care policy comes with the bells and whistles,
Mm, okay.
right? So, but the chronic care rider, you have to actually pay the person or whatever. You got to be involved in that process. But
Okay.
it's good to have
Okay.
that option. And the reason why you can only use up to 90%, it's because it's still a life insurance policy. So the 10% keeps it as such and
Mm,
not an asset.
got it. Okay. See, these are good
Mhm.
things to know. And then now again, insurance and retirement planning, which is very important. Life insurance can play a valuable role in your retirement strategy, providing both protection and supplemental income during your golden years. So let's just go through these bullet points real quick. Annuities provide guaranteed income streams that you cannot outlive. Cash
Mhm.
val cash value life insurance can supplement retirement income through tax advantage policy loan. Excuse me, it protects against longevity risk, the possibility of outliving your savings. Life insurance retirement plans offer tax growth, excuse me, and distributions. Excuse me for 1 second. Sorry about that. Excuse me. And then surviving spouse benefits ensure your partner's financial security after your passing. Yonette, can you explain a little bit about annuities?
Yeah, annuities, it's an excellent way of not outliving your money. So a lot of times when we hit to the retirement years, um, some people are fearful of running out of money because we are living longer. But when you have an income annuity, it guarantees that you will receive X amount of dollars based on how much you put in every single month, or how you choose to get paid for the rest of your life. And most times people are paid more than the premium that they put in. Because so that's how when you see some people are living comfortably in retirement, is because they've planned well. So if you don't have these things in place and you have some cash or however you choose to save, you're afraid to spend it because there's no, you don't have that vehicle of an annuity in place that will guarantee that you get monies for the rest of your life. And should you, let's say, pass away while you haven't exhausted the premiums that you've put in, then your beneficiary will get the monies that you didn't use. So all is not lost. So that's the short and sweet answer, but it's, yeah, people are fearful to spend money in retirement because they're not sure. And when you see sometimes some elderly people have to go back to into the workforce is because they've run out of money. So
Yeah.
income annuities prevents that from happening. And so I always preach, if especially when you're young enough, do your planning, then your older self will thank you.
No, absolutely. And that's another area I think people don't really understand too much about annuities. And so again, that's an area where you should educate yourself so that way you're prepared and that this might be another option for you to think about when you start your retirement planning, which you should start now if you haven't already.
Yeah, absolutely.
So now tax considerations. So understanding the tax implications of life insurance is critical for maximizing benefits and avoiding costly mistakes.
Hmm.
Excuse me. Death benefits are generally received income tax free by beneficiaries, which is something very important. Cash value grows on a tax deferred basis inside the policy. Estate tax implications apply if the insured owns the policy at death. Do you want to talk about that a little bit, Yanet?
Oh, that's
In terms of just the taxes, well, we don't have to talk too much about taxes, but um, if the policy, I mean, if the beneficiary is the owner of the policy, is that a difference than
mm,
having a different
um
beneficiary?
no, your beneficiary cannot own the policy.
Okay.
Yeah, that's because you insure a life.
Mm-hmm.
So the policy pays out when you pass away. So you cannot be the beneficiary of your own policy.
And
So is
people
that
have,
is that what people do for the
no,
estate
yeah.
tax? Yeah,
I've
because
seen
I mean,
people ask about that. I
yeah,
believe it or not, believe people have asked
yeah,
about, well, can I make myself the beneficiary? And I'm like, yeah, no, you can't do
um,
that. Um, but again, it's about educating yourself on how these policies work and making sure that, you get the right benefits. Gift
yeah.
gift tax considerations arise when paying premiums on trust-owned policies. And again, once you sit down with an estate planning attorney, they'll go over all these different things. These are just to give you some information about tax considerations. Proper ownership structure, such as an irrevocable trust, can eliminate estate tax on proceeds. We talked about that. Always consult a qualified tax advisor before making changes to policy ownership. So again, it's about just understanding what you're getting into and just understanding what you have to do in order to make sure that this works for you. So what are the common planning mistakes? You want to avoid these common mistakes that can save your family significant stress and financial loss. So outdated beneficiaries. I can't tell you how many times I tell people all the time, look and see who your beneficiaries are. People have outdated beneficiaries all the time. It's not just something that happens rarely. Failing to update designations after marriage, divorce, or birth of a child is very important. There's also, when people get divorced, I always ask for the judgment of divorce because sometimes there are things in there that have to coordinate with some of the assets that you have, and maybe an insurance
Mm-hmm.
policy might be in there. I have to make sure I see that before anything is done. And people, you have to be forthright about those judgments and what you agreed to when you got the divorce.
Mm-hmm.
Insufficient coverage, carrying too little insurance to replace income or cover obligations. So that's
Yeah.
a big one. A lot of people are underinsured. Um, I don't know how often you come across people who are overinsured, Janet, but I'm willing to bet
No,
that most
it's
people are
mostly
underinsured.
underinsured. Most people are underinsured.
That's what I thought.
And
Um,
some it's because it could be affordability, and some, believe it or not, people feel, oh, I don't want to make them rich when I'm dead, or some people
yeah,
have different ideologies, so they would just take out a minimum policy. And if you have a family and you love your family, I mean, if you take out $100,000, let's say term policy, you think how long do you think that will last? If you're no longer here.
yeah,
So, it's as an agent, we have to overcome a lot of obstacles when, you know, meeting with clients to do their planning, because, some people, coming from different histories and,
yeah.
predispositions. So, yeah.
Absolutely. I say that all the
Mm-hmm.
time, and this is why I say it's a mind shift.
Mm-hmm.
Because we're overcoming a lot of different things when we meet people, and we meet people where they are. Sometimes it's historical, sometimes it's experience, it's family issues.
Mm-hmm.
It's a whole bunch of things that we have to overcome in order to help people get to where they want to be, but they don't realize sometimes that mentally that's what's holding them back. How they
Yes.
view money, how they view assets. Sometimes I've seen it where, people will say, "Listen, when I'm gone, let them figure it out themselves." And that's not a good strategy in my opinion. But some people feel that way. So if that's the conversation we're having, that means there's a lot that has to be overcome during the course of that conversation in order for me to help someone plan appropriately. So, but again, you got to meet people where they are. Another common mistake is improper transfer ownership, not properly transferring policy ownership to an irrevocable trust. You see that happen a lot of time when people try to qualify for Medicaid. Um, and then sometimes people just get a regular living trust. But if you get a regular living trust, that asset is still included in your total estate assets. Like I said, when you put it in an irrevocable trust, then it is no longer a part of your estate. It's taken out. So you got to get the right ownership, trust ownership in order for it to work. The other thing people do is they create the trust and they don't fund the trust. If you transfer your property into a trust, there has to be a deed transferring the property to the trust. And so if you didn't do that, then you didn't properly transfer the trust. So that can be an issue. Also, lack of coordination, failing to align insurance with your overall estate plan. A lot of times people view insurance separate from their estate planning because they say to themselves, okay, I have a beneficiary on the insurance policy. But as we explained to you earlier, you should be coordinating your estate plan with insurance, long-term care, education, business continuity, all those things should be coordinated together. So when you don't coordinate or you look at them as separate things, then a lot of times you will miss something and it will cost you later on. So you have to coordinate all of these things together. Ignoring long-term care, overlooking the need for coverage that addresses extended care costs. Again, that's a big one. A lot of times people say to me, "Nope, I'm going to take care of so and so."
And we ask, do they know that?
Right.
And then I
You
don't
know,
know, like if the person has their own family and such, like, do you think that they can afford or are able to take care of you?
hmm
Should, you know,
yeah.
hmm
And so because the thing that is most troubling is that we're not having the conversations that we need to have with the people we need to have them with. So again, you can have in your head what what you want to do or what you think should happen, but if you haven't spoken to the person who this involves, then you have a problem. The same thing with your estate plan. Again, you have to think about all the people who are going to be involved and plan accordingly. So it really requires a mind shift. It requires communication. It requires being proactive with planning and speaking to the right professionals so that way you will put the right things in place. So that's very important. Planning for families, right? So life insurance planning takes on special importance when you have family members who depend on you financially. And that happens all the time, right, in families. Protecting minor children ensures funds are available for daily needs, childcare, and guardianship. Special needs planning, again, we all have different types of families. Some of us have special needs children. We have special need adults that we have to take care of. There are things that need to be taken care of. So supplemental needs trusts funded by insurance protect disabled family members. College funding, we talked about that. Guarantees education goals can be met even if a parent passes away. And then, of course, generational wealth creates a lasting legacy that supports children, grandchildren, and beyond. And as Yonette said, the book, What Would the Rockefellers Do? That's a great book to read to understand how people provide for their families generation after generation after generation. And you want to get there too, but it requires a lot of planning. So, again, when we talk about protecting minor children, I'll give you this example, which is my example. When my daughter was, I think she was like 3 when we did our wills, right? And we bought our house. And I believe we bought the house. I can't, don't quote me, but let's just say it was like 450,000. So I'm asking you, Yonette, if you have a child that's 3 years old and you have a house with a mortgage on it that's for 400, let's just say 500,000. Would I get a policy for 500,000?
no,
No. What I would get a policy that is more than that because that child is a minor child, right? Of course, we want to pay off the mortgage, but once the mortgage is paid off, someone has to take care of the child, right?
that's right.
So
Yeah.
that's where people are underinsured because they say, okay, I'm going to get a policy that covers the mortgage. Even if that child was 21, even if that child had just gotten into the workforce, I always use this example with my house. We have a policy, it will pay off that mortgage, which is significantly lower today, right? Because we've
hmm
been paying on it since I believe it was
hmm
2008, let's say. Um, so it will pay off the mortgage, but if my daughter inherits the house, she got to pay the taxes. She got to pay utilities. She has to pay the insurance on the house because no mortgage. Usually the insurance will be included, the insurance that you have to have on the house will be included in the mortgage. But if the mortgage is paid off, now you got to pay that insurance policy annually, right?
hmm
So you got to pay that, taxes, utilities, um, And that's before you get to your car payment, your car insurance payment, and your food and all the other stuff. So even with that insurance policy paying off the mortgage, the monthly amount that my daughter would have to come up with to just maintain the house without a mortgage is gonna probably be at least $3,000.
Mm-hmm.
So you see how just paying off the mortgage is not enough? You have to make it where, you pay off the mortgage plus you give the child the ability to live. Do you want to speak to that, Janet?
Absolutely. Because most of us, we sacrifice to have the homes that we purchase, and we sacrifice, a lot of sacrifices go into keeping the home. So if we don't make the provisions for, because none of us is getting out of here alive, um, then if we don't make the necessary provisions in terms of putting the proper protection in place, then whomever we're leaving the home for may not be able to manage it because of lack of funding, and then they'll lose that home that you had intended to stay in the family or create generational wealth, or
Hmm.
leave a legacy behind for your children. So you have, as you spoke on that, Rhonda, be realistic about the circumstances as you know it.
Hmm.
Even if your daughter is, if she's out of college, she's not earning enough to absorb all that expenses. And what is she supposed to do?
Right. I mean, and
Right.
that's why,
So,
yeah. And that's why, people who inherit these homes from their parents, a lot of time they view it as a burden because they don't have the money to take care of the house. Whereas other communities will look at it as, okay, this is an asset. When you're trying to live and then you see that you have to upkeep this house, you have a
mhm.
taxes that you have to pay yearly, you have to put insurance on it. Again, a big mistake we make is if the mortgage is paid off, you have to have insurance. You don't have to, but you have to. I always say you don't have to, but yes, you have to. You have to have insurance on the house. If the house burnt down, who's going to pay for it? That's when people swoop in and try to take your house from you because they'll come in and say, "Oh, I can get this fixed up for you. I just need you to sign these papers and I'll have it fixed up for you. And then you can pay me back." And that's when now we have more issues than we bargained for. But you have to put yourself in a position where you're prepared, where you're covered, where you're not at someone else's mercy, so you won't be taken advantage of when the first person comes along and try to offer you something that seems like it's a viable option because you're stressed out because you don't know what to do. And that's why you have to understand that if you're trying to plan generational wealth, I say this all the time, is an action verb. It's not something that is stagnant. You can have $1 million, but if you don't know what to do with that $1 million and you haven't educated someone, then that $1 million is not going to continue to go down with each generation. It's going to stop at some point because you don't know what to do. So, all these things that we're talking about are planning. You have to plan proactively to make sure that the legacy you created goes beyond you. It supports your children, your grandchildren, and beyond. And that's what we're talking about here. I'll just say something about planning for business owners. Again, business owners face unique insurance planning challenges that require specialized strategies. Buy, sell funding. You really have to look into that. I think every business owner should look into that, especially if you have a business that you believe in, you're passionate about, and you want it to continue after you. Um, you really have to think about that. Life insurance funds cross-purchase or entity purchase agreements for ownership transitions. We don't like to think about ownership transition. I totally understand that, but it's something that we have to plan for. Executive compensation, split dollar and deferred compensation plans attract and retain key talent. Again, when you have insurance to fund these things, you make your business more attractive, but you also maintain the continuity of your insurance and its viability. A lot of times we undervalue our businesses because we don't put in the right mechanisms in place. When you have insurance to fund certain things, you can attract the best talent. You can train people properly. You can do all these things for your businesses. Business loan protection. If you have an SBA loan or you have any type of loan, lenders often require life insurance as collateral for business loans, depending upon how big it is. Not everybody does that. But again, if you have an outstanding loan on your business at the time the owner passes, that insurance policy can pay off that debt and fund other things. Employee retention, group life, and supplemental benefits help retain valued team members. So, again, think of insurance more broadly so you can understand the benefits that it has for you. So, we can give you a whole bunch of real world case studies, right? Just one situation is a family-owned manufacturing business with three partners. The founding partner passes away unexpectedly, leaving a spouse with no role in the business. What is the solution? A cross-purchase buy-sell agreement funded by insurance, life insurance, allowed the surviving partner to purchase the deceased partner's ownership share at fair market value. That's a way for you to not inherit a partner that you didn't anticipate and have the business continue the way you want it to continue. The outcome, the spouse received full fair market value for the ownership share. The business operations continued without disruption. The surviving partners gained clear ownership, right? And then employees retained their jobs and stability. All that by an insurance policy. Again, these are the type of things that we want you to think about because you can do a lot with insurance if you understand its role. And that's what we're here for. So we're just about at the end because I'm sure people have some questions. What are your action steps? I hope you're taking some copious notes. Taking these steps today can protect your family and secure your financial legacy for the future. What do you want to do? Review your current policies. I'm telling you now, I've had people who have been paying on policies for 30 years and have no idea. Some of the companies actually even went out of business and was acquired by another insurance company. So they don't even have the information on who the new insurance company is. You have to review your current policies. You want to ensure coverage amounts match your current needs. Update your beneficiaries. Please update your beneficiaries. Verify designations reflect life changes. You definitely need to reevaluate things when you have a life change, such as a divorce, a new child, loss of a job. Something might happen. You have to really make sure you update your beneficiaries. Number three is coordinate with your estate plan. These are not separate things. Your estate plan should align with your insurance, your business, everything, your educational goals for your children. All those things should align together. So align policies with wills, trusts, and power of attorneys, and all these different things we talked about this evening. Number four, evaluate long-term care needs. Consider coverage before health issues arise. And then number five, consult professionals. Work with legal and financial advisors. That's definitely what you want to do. These are the five things that you really need to think about and start to look at so that way you can effectively plan. Now, I saw that there was a question. Here's our contact information. And I know that Yonette has put her information in the chat. Let me just stop sharing real quick. And before we answer any questions, I do want to just say something. And Yonette, I know that you are going to add to this as well. So here's the thing. Um, Health is very important when we talk about insurance. When if you're going to get the type of insurance that we're talking about, health is important. And see, I understand that in our communities, we always have burial insurance. I've spoken to so many people who say, again, that's a death benefit, right? And we don't want our loved ones to have any debt when it comes to burying us and all that kind of stuff. I understand that. But we have to think more broadly about insurance. But in order to do that, in order to qualify for this, we have to get our health in order. Health is very important because if I'm trying to take out a whole life policy for $2 million or even a term policy, they're going to ask for, they're going to see what my health is like. So do you want to comment on that, Yanet?
Yeah, so um the integrity of your health comes into play with approval for a life insurance policy, and it also your health rating determines the cost as well as your age. So the younger you are, the better. The young and healthy, or not so young and healthy, is important because certain health conditions, like if you've had a heart attack, recent heart attack or stroke or whatever, it may render you uninsurable,
Hmm.
right? Certain cancer diagnoses, you know, um, you know, believe it or not, if certain I've had it where, we went through the whole health process, but the person had an event with the law and was incarcerated, and it depends on the type of charge. They be Some insurance companies will reject them as well. So, it's important for us to do our planning as soon as we can and not wait for later, because later you may be precluded from getting it, or it would cost you so much for a smaller policy. Yeah.
Right. And
Yeah.
then don't and some people think that they have to start thinking about this when they're in their 50s.
No.
Nope.
No, it's so costly. I mean, if you don't have it, and that's when you had your come to Jesus meeting and with yourself, then you can't reverse the time. But
Mhm.
no, I have young clients, and it's advantageous. For instance, like one of my clients, she's 31, she makes a good salary, and no, she's only responsible for herself, and she took out a custom whole life policy for 250,000,
Mhm.
and she pays on an annual basis because she gets her bonus, and she customized it be fully paid up in 15 years. So by 46, the policy is fully paid up. And because she works in the financial um, field, in finance, and so she understands that aspect of it, and she was looking at the cash value component,
And
you
that was,
know.
yeah, that was smart.
Hmm.
And
Yeah.
myself included, when I first got my first whole life insurance policy, I was single in my 30s with no kids, not married. I had spoken to some people about getting insurance, and at the time, I only had nieces and nephews. But I'm telling you, what motivated me was I'm a first generation college graduate, and I wanted to make sure that my nieces and nephews were able to go to college. So I had started to get my insurance in place back then because I thought it was just an important thing. And then once I got married and had kids, I changed things around and evaluated my policies and made sure that I now still included my nieces and nephews, but also, made sure that my kids were taken care of. So again, one of the first things someone said to me was one of the easiest ways you can make your children millionaires is to get a life insurance policy.
Mhm.
Especially you're talking about people who Do not come from money. I don't come from money. I was the first person in my family to be an attorney. So I didn't know I had to figure it out. But once I figured it out and I tried to figure it out sooner rather than later, that's when I started to put things in motion. So again, don't think it's too early to start in your 30s. It's not.
You'll get a whole lot more for less.
A whole lot more for less. Absolutely.
Yes, yes.
So with that,
Mm.
we will, do you have anything else to add, Janet?
No, I mean, if as I will avail myself to anyone who has any questions, you can call me. And also, if, I'm open to doing a courtesy review of what you already have, just for an educational piece and, and any questions, because most of us, we don't understand the policy and some companies sell universal life policies and they as a whole life policy and it's not.
And it's not.
It's not.
Absolutely. And so we want you to have a clear understanding of what policies are available and
Mhm.
what benefits
Well,
they have
yeah.
and why you should get one over the other or whatever the case is. But,
Mhm.
again, once you speak to Yonette or someone about your specific situation, she'll be able to guide you from there.
Yeah. And it's just a needs assessment because I if you're single, no children, you don't need um millions in coverage or whatever, right? So it's all about the needs assessment and what's appropriate for you, what type of policy and your affordability. Because I
Right.
also don't believe in stretching yourself so thinly that you're struggling to pay the premium.
Right.
Yes? Yeah.
The other thing I told people is that, when I initially got my policy, what I would do is when I was working and whenever I would get a raise,
Yes.
whenever I'd have more disposable income,
Mm-hmm.
I would figure out, again, because there's products where you can start out with term and then you can convert to whole life.
Convert, yes.
So again, once you understand what's available, and what you can do, like Yonette said, you might want to have whole life, but right now in your particular the lifestyle and where you are, you might not be able to afford as much as you want. So that's okay, but you start somewhere. But that's why the evaluation needs to take place. So whenever I would get a raise and I would see how much more disposable income I would have, I would go back and say, okay, so let's increase this. I would go back and try to do something like that as opposed to, oh, let me buy a new handbag. But that's just me, but I think it's more important to look at my insurance so that way I can make sure my planning is appropriate for what I'm trying to accomplish.
Absolutely. Absolutely. Yeah, and it paid off for you that the actions that you took. So when you needed the extra cash, you didn't have to stress about it. You know exactly where to find it.
Right.
Hmm.
Absolutely. So
Yeah.
thank you so much, Janet, for
You're
joining us
welcome.
tonight.
Thank you for having me.
Of course. So now, does anyone have any questions? There was a question about the health aspect, and I think we answered that. I don't know if there were any other questions in the chat, but we'll take a look. Does anyone have any questions? Oh, when are we having another one on this? We'll do an assessment and figure out when we will have something like this. But we do these type of webinars on different topics. Insurance is just one of them, but we talk about different topics related to estate planning. So that way, you can build your assets and transfer them properly and create generational wealth. So we'll have something else, um, on this topic and other topics related to estate planning. Do I have a Brooklyn office? We have office hours. Myself and also Yvette Dudley, who is also on this Zoom. We have the estate planning and foreclosure clinics at Medgar Evers College. The Boys Bunch Center. We have office hours. I don't know if we could put that in the chat, but if you registered for this, I think Aaron, we would be able to include them on the notices that we have that goes out about our clinics.
Yes.
Okay. So Christopher, yes, we do have office hours in Brooklyn at Medgar Evers College. Um, when are we having another one like this? So we do have these webinars at least once a month. Sometimes twice a month on topics like this, which we understand the community needs. We are educating as much as we possibly can because we understand the importance of estate planning. We're going to have another in June. We have a couple of webinars coming up. One is actually on deed theft. Yvette, if you can unmute yourself and let people know about the upcoming um, webinars that we have coming out soon.
Yes, hi everyone. Very informative as usual, Rhonda. That was a beautiful, very informative Zoom presentation you just did,
Thank
and
you.
congratulations to you, Yanet, as well.
Thank you
Um,
so much.
yes, so we do have a few. You could talk about the deed theft one. On June 2nd, we have a foreclosure one, loss mitigations and foreclosure. So we'll talk about all the various options you have in foreclosure, like loan workouts, loss loan mitigation, speaking with HUD, partial claims, and things like that. That's for June 2nd. And then you could talk about the June 17th one.
Yes, the June 17th webinar is going to be about deed theft, preventing deed theft. So we're going to talk about all the different things that you should be doing, especially if you own a property or if your parents own a property, or so that way you can preserve that generational wealth that we're talking about. We're going to talk about all the different actions that you need to be taking now in order to make sure that asset is preserved.
That's good
So,
stuff.
yeah, we try to give you these webinars to educate you and arm you with the right information so that way when people come along and tell you something differently, you know better, but also so you can get in contact with the right professionals who can help you accomplish the goals that you need to accomplish.
Yes.
We're here to help. Each one teach one. That's right. Well said. And we put in the chat the estate planning clinic as well as the foreclosure clinic. So if you can download that, for those of you who asked about our hours, and where you can make appointments to talk about any estate planning or foreclosure issues that you have, we're here to help at the Du Bois Bunch Center. Latoya, would you like to speak before I guess we end soon. We have a few minutes. If anyone has any questions also, you could let us know.
No, thanks, Rhonda. I just want to just to reiterate that we just dropped the flyer in the chat for folks that want to sign up for a free consultation to meet with Rhonda. I'll also drop the flyer in the chat for our other consultation with Yvette's firm around deed theft and foreclosure consultation. And I think great job, Rhonda. Thank you.
My pleasure. Does anyone else have any questions before we end? Okay. Well, thank you guys for joining us this evening. We appreciate you coming out tonight to listen. We hope this information was valuable to you. Again, please stay tuned. We have a lot more webinars on wonderful topics that we know will help you in your planning. So please stay tuned and stay in touch.
Thank you. Thank you
Thank
so much
you.
for having me.
Thank you. Have a good night.
Have a good night.
Thank you,
Bye-bye.
everyone.